practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years. Let's begin. Though the economy might seem complex, it works in a simple, mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are...
Hello to all of you, and it is time for a great webinar, and one that I've been preparing for a long time, and that is the Changing World Order according to Ray Dalio. My name is Scott Pickett. I'm the CEO and founder of Wealth Migrate and the chairman of the Global Wealth Group. And what I wanted to invite you on tonight is a journey. I'm going to explain who Ray Dalio is. I'm going to talk more about the video that I was just playing as people were entering. And really for me tonight, I want to share with you some important things. You know, there's a lot of talk at the moment about the dollar, the US dollar crashing. There's a lot of talk about why it's going to happen and how it's going to happen. There's a lot of talk about a changing world order. What's really important though is when you look at it is that you take a data approach and rather than hype and people's opinions, you look at data, you look at patterns, and you look at trends. And I believe that Ray Dalio is the world's best when it comes to this. And that is why tonight we've dedicated an entire webinar to unpacking and understanding where he thinks the world is and where it's going. And on top of that, I'm going to actually share with you 6 things that will enable you to not only protect yourself, but profit during the coming next 5 years. Now, some might call it a correction, some might call it a crash, some might call it the changing world order, and some believe that in chaos, there's opportunity. You get to choose. And so I can see that there's a number of people coming through here in the chat. I just want to make sure that everything that you can hear me loud and clear. So hello to all of you from wherever you are in the world. I can see that we've got some here from Pretoria. We've got some from New Zealand, and we've got some from Portugal. So we've got a very broad brush of people, and India. So Namibia, Georgia. So nice to see that we've got such a wide mix of people from all over the world. So tonight I've got quite a challenge, and that is because, you know, we live in very, very interesting times. And to be honest, we've lived in interesting times for quite a long time. But there's a chart called the VIX chart that looks at the volatility index. And when you look at this volatility index, and if you look back as far back as it goes, you know, 2009 was the last major volatility that we had. The dot-com boom bust in the late 90s, and then the coronavirus and where we're at the moment. I can see we even got Russia. So wonderful to have so many of you from all over the world. Why I've got a challenge is that this gentleman, Ray Dalio, is one of the most interesting people that I've ever come across. And what's also really interesting is that where we find the world at the moment, there's so much complexity, there's so much change. And within all of that, it's very difficult to understand what's going on. Now, what's interesting to me is that nothing I'm going to share with you tonight, you cannot already find on the internet. As others say, and I've heard this from a number of other people, there's a plethora of knowledge on the internet. We are drowning in knowledge. But what we need is direction. And so Ray Dalio says, I believe that the times ahead will be radically different from the times we've experienced so far in our lifetimes, though similar to many other times in history. What I'm going to try and do tonight is synthesize his information and put it into simple concepts for you so that I provide you with direction and allow you to take action. Now, who is Ray Dalio? Well, firstly, he's an American billionaire and philanthropist. He did a Harvard MBA. He studied and then started a company called Bridgewater in 1975. He received $5 million from the World Bank Retirement Fund within 10 years of starting the company. In 2013, it was the largest hedge fund in the world, and it had $138 billion of assets under management. In 2020, he was the 79th wealthiest person in the world with $18.7 billion to his name. He wrote this book, Principles. Now, the first gift I want to give you is please make sure that you read this book, Principles, because it's one of the best books I've ever read. Now, that's quite a big statement for me. I've read a hell of a lot of books, and I really, really recommend that you read this book because it's, as I said, it's got some incredible lessons to learn in life about life and business. And really, for me, it was back in 2017 when I read this book that I started to understand who Ray Dalio was and really get deeper and start following what he is all about. He shares a lot on LinkedIn. And so tonight, if I go here and I go through to LinkedIn, you can see his LinkedIn profile. And all the chapters that I'm going to go through tonight, he's actually putting his book on LinkedIn. So one of the things that I've done in terms of my research tonight is that I've gone through and looked at all the different things. I've looked at his video on how the world economic machine works. I've read his book, actually, the chapters and chapters of his book, up to chapter 7, which is the latest chapter he's posted. You can actually see, and by the way, all these links I've actually provided for you. And for those of you who are watching live, you'll get access to these links. I've watched a number of interviews that he's done over the last couple of months. And I've even watched a video where a gentleman called Roger Hamilton took a lot of what Ray was talking about and synthesized it, because I really, really enjoyed an important understanding from Roger and what his take on what Ray Dalio was saying. And then, there's his book on structural reform and why countries succeed and fail, why and how capitalism needs to be reformed, why Ray Dalio says that cash is trash. He said that at the World Economic Forum in Davos in January this year. And then, what his opinion is on the big picture and his economic principles. Again, this is all his websites. So as you can see, I've done a tremendous amount of research, and we'll go into some of these other articles later. Now, what's important for me is that I believe that he's one of the most respected people globally in the world in terms of economics. And why is that? Because for more than 40 years, he hasn't used opinion, he uses data. And what I loved about his book in LinkedIn was that he calls them principles. And so if I look at my notes here, he was in Wall Street on the trading floor when Nixon took America off the gold standard back in 1971. He realized that the market moved in waves, and while others were only focusing on the short term, he focused on 10, 50, and even 100 years. In early, and by the way, we'll talk more about Nixon later. In early 1980s, he went public talking about the debt cycle and how emerging economies were going to go bankrupt. And he got it right and became a very well-recognized name. And then a year or two later, had another very bold statement and got it wrong and actually went completely bankrupt and couldn't afford. He had to get rid of all his employees, had to borrow from his dad, had to go live with his parents. And that was such a painful experience for him that he decided to turn everything into code, to turn everything into algorithms. And so as early back as the early 80s, he started to look for all these patterns and created algorithms to help him start making better decisions. And was one of the first people to put it into computer systems. And what's interesting when one looks at all this is that there is so much information. And one of the real challenges I had was to distill this information. Now, there's one other thing I wanted to share with you. They run the largest hedge fund in the world. And you can see here, I decided to put up a hedge fund because I don't know if anyone wants to describe what a hedge fund is, but tell me, what do you think a hedge fund is? And Artin, I just want to see here quickly, you've put through a comment. So Artin, perfect. you'll get my contact details later, and we happily, share them with you. So I can see Gavin says absolute returns. Alan says trading with algorithms that is leveraged. It's really interesting, trading with anything that's leveraged. So it's really interesting. I went to Wikipedia today to look up a hedge fund just to make sure that I'd got this clear. So we've got hedge inflation, well diversified. We've got for high net worths. So it's interesting. If you look here, it's a hedge fund is a more complex trading, portfolio construction, and risk management techniques to improve performance. Because of its complex techniques, financial regulators typically do not allow hedge funds to be marketed or made available to anyone except institutional investors, high net worth individuals, and other investors who are considered sufficiently sophisticated, such as accredited investors. Hedge funds are regarded as alternative investments, and they are different from the regulated investment funds available to the retail market. They look for a positive return, regardless of whether markets are rising or falling, so an absolute return. And the expected returns of some hedge fund strategies are less volatile than those of retail funds with high exposure to the stock markets because of the use of hedging techniques. They typically charge a management fee of 2% annualized of the net asset value of the fund, and the performance fee, for example, 20% increase in the fund's net asset value during the year. Hedge funds have existed for many decades and are becoming increasingly popular. They have now grown a substantial fraction of the asset management industry, with assets totaling $3.2 trillion in 2018, and some hedge fund managers manage several billion dollars. Now, as I told you, Ray Dalio and his team at Bridgewater manage $138 billion. So what I think is really interesting is that one of the things that I learned many years ago is that if you want to be successful, the fastest way to be successful is to copy successful people. If you want to be wealthy, the fastest way to get wealthy is to copy wealthy people. If you want to invest like a hedge fund and get the results of a hedge fund, then you need to copy what they do. And really for me, what's exciting is that tonight, once I've shared all these concepts, I'm going to share with you the principle of Wealth 5.0. I'm going to share with you how the world is dramatically changing, not for all the reasons Ray Dalio I'm going to share with you, but equally why the world is changing and why Wealth 5.0 is so important to you and how you can now actively get involved. And like I said to you, I'm going to share with you 6 things that you can do to not only protect yourself, but actually profit during this time. And so what I find absolutely fascinating is that before I get started, I wanted to say thank you. And the reason I wanted to say thank you, and one of the reasons I did this webinar, is that I wanted to add value to you. But if I look at it from a selfish perspective, I also wanted to learn and force myself to go and study Ray Dalio. I've known about his books, I've known about his LinkedIn articles, and I haven't taken the time to go and fully and truly understand them. I've kept a lot of resources, but I've never actually deep dived. And in the last 48 hours, I have closed my doors, canceled any meetings, done no personal engagement. I was up till 2 a.m. in the morning last night. I was up at 8 a.m. this morning. I've literally not stopped as I've studied everything that I could find about Ray Dalio. And so for me, I want to say thank you, because I believe that 24 hours ago, all of this stuff was very overwhelming to me. It was a huge amount of information. And the one thing I will say about Ray Dalio is that he gives so much information that you can get analysis paralysis and you can get lost. And you can also get bored, to be honest. And so I delved through it in detail. And one of the things that they talk about in the learning pyramid is the best way to learn anything is to teach others. And so you're giving me a gift tonight. I'm giving you a gift and you're giving me a gift in return. Because by me taking the time to learn all of this stuff and to synthesize it in my own mind, now allows me to understand it. And I'll tell you what, my overall takeaway is I was with my business coach today, Richard Neft, and I said, it's really quite scary where the world is. And it's really quite scary where the world is going. And particularly for people that are unprepared and don't understand this stuff, I think we're going to be in for a very, very painful period. But for those of us that take the time to understand this, to understand the trends, the patterns, and this changing world order, we can not only survive through this process, but we can actually navigate ourselves into this future and actually thrive. And that for me is incredibly overwhelming and incredibly exciting. And I also believe that there are paradigm shifts happening, and you're going to see why, that I've been talking about and our team has been talking about for months and years. And what Ray Dalio is about to share with you is only going to accelerate that. So let's look at what is happening now. He says, most importantly, I'm seeing the confluence of high levels of indebtedness and extremely low interest rates, which limits central banks' powers to stimulate the economy. Large wealth gaps and political divisions between countries, which leads to increased social and political conflicts. A rising world power, China, challenging the overextended existing world power, the US, which causes external conflict. And it's the most recent time where it was similar to now was the 1930s to 1945, which included the Great Depression. They included some of the worst droughts in America, which again is a natural problem. They included the Second World War, which devastated lives and tens of millions of people were lost. And many percentage points of the world's GDP was equally lost. And so it's very concerning to him. And for me, when I really trust and respect someone, if it's very concerning to him, it's very concerning to me. And I think it should be very concerning to you. Artem, thanks for your details. I will definitely reach out to you. And as I said to you, I'll put my details at the end. So how does it all work? Well, because most people in their countries want the most in wealth and power, and because money and credit are the biggest single influence on how wealth and power rise and decline, if you don't understand how money and credit work, you can't understand the biggest driver of politics within and between countries, and you can't understand how the world order works. And if you don't understand how the world order works, you can't understand what is coming at you. Now, the metaphor I like to use, as you might or might not have heard me say, is that it's a bit like a tsunami. We're on the beach, and whether we like it or not, the tsunami is coming. And what I found fascinating when I did all this research is that what he basically said here is if you don't understand how money and credit works, then you're not going to understand the politics. And if you don't understand the politics, you won't understand the world order. And if you don't understand the world order, you will not understand what's about to happen to you in the next 5 years. And so welcome and well done for being on this webinar. And maybe if you find value out of it, share it with others, because I think we've all got a responsibility for others to realize what is about to change in their lives. We've agreed that the two most essential understandings are to understand how money, credit, and economics work, and how domestic and international politics work. So the question is, how many of you actually understand how the economic machine works? How many of you understand how economics, money, and credit work? Now, there's a video here that I highly recommend that I watched last night. And all the links, as I said to you, are in the slideshow at the end. And it's a 30-minute video, and I found it incredibly powerful. And, highly recommend, even if you've got a PhD in economics, highly recommend you rewatching it, because I believe in the last 24 hours, it feels like I've done a PhD in economics at Harvard. And I want to share with you some of the principles I took away from this video. The first is that there's two economies. There's the real economy, which is all about productivity and transactions. So that, and I'll explain that a little bit more. And then there's the financial economy, where central banks drive the capital markets. And what's really important to understand is that although there are these two economies, these two parallel economies, what's important is that there's three major forces. And so today, if you're taking notes, I really recommend, and I'll share the slides with you as well, I've tried my best to synthesize this and to put it into frameworks. And so there's three major forces. The first one is productivity. And as you can see, the second one is the short-term debt cycle, and the third is the long-term debt cycle. So let's explain that in a little bit more detail. productivity is quite common sense. Each of us is productive. Depending on how productive we are, is how successful we are. And both people and economies have more productivity than other people and economies. And what tends to happen is the productivity tends to sort of go up and down slightly, but in real terms, it really just goes up in a trend because people and generations get better and better and better consistently. And so it tends to be a straight line. And what's important when you look at productivity is that it's ultimately determined by the number of transactions. And the transactions are goods, services, and financial assets. So it's when you and I buy or sell goods, services, and financial assets. The total amount of spending drives the economy. And the amount that is spent by the quantity sold is the price and ultimately leads to the number of transactions. And so what's really, really important here is that everything when it comes down to productivity actually comes down to transactions. And you need to calculate what is the transactions happening, what is the productivity of a country and its population. The second is, and sorry, there you've got the first major force, productivity. The second is the short-term debt cycle. And sorry, let me just check my notes here quickly. Yep, the short-term debt cycle. What's really interesting here is that money is different from credit. And so money is what you settle transactions with. So if I go, and he's got a good analogy, if I go to the bar and I buy a beer and I pay with cash for my beer, there's an immediate transaction and I've settled the transaction. However, if I buy that beer on using my credit card, then effectively I'm taking on a debt, which is an asset to the bartender and a liability to me, which becomes credit. Okay, you with me? So it's an asset to the bartender and a liability to me because I owe him a debt, which ultimately becomes credit. Now in the US, the credit market is worth 50 trillion today, and the money supply is worth 3 trillion. So it's very important to understand that money and credit are two different things. And what's also important is that when one looks at the short-term debt cycle, as much as we like to think that there's more innovation and then less innovation, it's actually not. And again, coming down to productivity, it's not. It's more credit and less credit. So what this means is that the reserve banks around the world, the way that they've controlled monetary policy, and he calls this monetary policy 1, is where it's interest-driven monetary policy. And basically what happens is that when the economy is growing, the government, or the Reserve Bank, lowers interest rates, which allows economic growth. But the problem is inflation starts to go up. And so what they basically do is that they tighten credit and they make debt more expensive. And so inflation goes down and there's less credit, and then they loosen it up again. And then the cycle repeats itself. And that's called the short-term debt cycle. Now, what's important is that in the short-term debt cycle, it's all driven by the central banks and by interest rates. They effectively are printing money. So the credit is the most important part of the economy. The more we spend, the more someone earns. And the more spending means more income. More income means more lending, which means more spending. So it's a virtuous cycle. And credit becomes debt, which is then ultimately lent. So the problem is that when there's so much credit in the system, we basically buy things we buy more than we actually produce. And in this cycle, we do less transactions than we actually produce. So over here, there's an undersupply, which pushes up prices, which leads to inflation. And here there's an oversupply, which pushes down prices, which leads to deflation. And as I said to you, the productivity kind of tends to go up constantly. And what's really important is that in the short-term cycle, sorry, I just want to see my notes here quickly. There's one point here that I want to just mention, which is very important. The debt cycles and the credit cycles are very important in the short run, and productivity is very important in the long run. And so when you look at it, if you take the short-term debt cycle, you can see that you've got the first major force, which is productivity, going up consistently. And then you've got the short-term debt cycle, which goes from this trough to this peak to this trough. Okay, and like I said to you, this is traditionally known as a business cycle, and it's ultimately monetary policy one, which is what's been going on for the last 70 odd years, which is interest rate driven monetary policy. And then you go to the long-term debt cycle. And this is where it gets really interesting, because this is where I started to. So everything that I sort of said up till now, I think I understood, although it was very good to do a refresher. But what's interesting is that each short-term cycle ends better than where we were. But more debt, as human nature is, people borrow more and more and don't like to pay back debt, which leads to a long-term debt cycle. So if you look here, if you take that short-term debt cycle, is that each and every time it do the cycle, it goes up, because it always ends better than the last cycle. Look, this one, this cycle is here, this cycle is here, this cycle is here. And even at the bottom, this cycle is here, this cycle is here. But what they're doing is that it's more debt is being accumulated because people want to borrow more and don't like to pay back debt, which leads to a long-term debt cycle. And ultimately what a long-term debt cycle means is a debt burden, which grows year on year over time. And the debt repayments start to grow faster than the income. And so if you look here, this was the last major debt burden in the 1930s, and the latest one that happened in 2008. And you can see it sort of consistently. And I remember the period, I'm going to talk about 1945 a lot. So if you look here, here's sort of 1945 here, and look at this period where, and then in 1971, and I'm going to explain why 1971 is so important, where they decoupled the US dollar from gold, and then the debt burden just started to increase and increase and increase until it peaked in 2008. And what's also interesting is the deleveraging occurs when interest rates hit zero. And there's only two times in the last 100 years that that's happened. Once in the 1930s and 1940s, and once in 2008. So, welcome to a journey. Now, when we get into deleveraging, the government, both the Reserve Bank and the central government, has a serious problem. And there's only 4 ways to solve it. The first 3 of them are deflationary. So they can cut spending. They can cut spending on people, businesses, and even the government spending. And it's called austerity. They did this in the late 70s and early 80s, and it had devastating consequences on the world economy. Secondly, they can reduce debts. So there can be defaults on debts, there can be restructuring on debts, but the bottom line is it causes the world economy to shrink. And thirdly, they can do wealth distribution. They can take from the haves, they can tax the haves and give it to the have-nots. Again, it contracts economies. And then you've got the inflationary method, which is where the central bank prints new money. Now, this one for me is really interesting because what he talks about is that there is the way to get a perfect balance, but it's a very fine line between the monetary policy one, and again, I just want to get my notes here, and monetary policy two, where in monetary policy two, they are printing and buying financial assets. They call it quantitative easing. So point number 4 is effectively monetary policy two, where they're printing and buying financial assets. Now, if they do too much of it, then they get into an inflationary cycle and everything goes against them and they incur too much debt. And if they do too little of it, then the economy doesn't grow, the transactions don't grow, the incomes don't grow, and the debt burden gets worse. It's a very, very fine line. And so ultimately, what you're looking at from a timing perspective is that the way it normally works is that for 50 years, you've got a leveraging period. Then for 2 to 3 years, you've got a depression. And then for 7 to 10 years, you've got a reflation. And it's a 75 to 100-year cycle. And so if we go back to the three major forces, you've got productivity, you've got the short-term debt cycle, and you've got the long-term debt cycle. And all three of them are overlaid. Now, if you're going to take a screenshot, this is the one to overtake, because everything I've said relates to either productivity, the short-term debt cycle, or the long-term debt cycle. And what's interesting when you look at the timing is that productivity is ongoing forever. People are arguably getting better and better and better as humans. It's just in their DNA. The short-term debt cycle is from 5 to 8 years. And as most people know, I was learning this back in 1995 at university in Economics 100. You've got the business cycle, which is 5 to 8 years. And this is that whole interest rates and inflation. Oil has an impact to play in that as well. And then you've got the long-term debt cycle, which is 75 to 100 years. And so the question I've got, before I get to the question. So 3 rules of thumb. I'm going to be giving you lots of tips and advice all the way through this. 3 rules of thumb. The first one is, and by the way, these rules of thumb are for you as an individual, they're for your company, they're for your country, and they're for this planet. Don't have debts rise faster than income. So you want to keep that balance between your income and your debts. Secondly, don't have incomes rise faster than productivity, because that leads to inflation. And thirdly, do all that you can to raise your productivity. So I want to applaud you all for being online tonight, because hopefully you're going to learn things tonight that are going to make you more productive and you more prepared. I know certainly it was an incredible experience for me going through this in this amount of detail. So where are we now? And I'd love people to just give me their opinion on where they think we are. Are we at point 1, which is like over here somewhere? Are we at point 2, which is over here somewhere? Are we at point 3, which is over here somewhere? Are we at point 4, which is somewhere over here? Or are we at point 5? Point 1, point 2, point 3, point 4, or point 5? I'm going to take a sip of water while everyone's engaging. So, what's quite interesting, we are in an extremely worrying situation. We are right there. We're on the precipice. We're on the precipice of 3 major forces that are all intersecting, both productivity, short-term debt cycle, and long-term debt cycle. So where and what next? And again, there are 3 major components. Again, I'm going to repeat myself. There is so much information here, but I've tried to keep it into frameworks. And so think of it in 3s and 4s, like I'm trying to explain it. So we agreed that the 2 most essential understandings are to have an understanding of how money, credit, and economics work. Now, hopefully we've already done that. And so now it's time to understand how domestic and international policies work. And it's really interesting when you look at the introduction here, because what's so interesting is that there's 3 major components. There's a long-term debt cycle, there's the domestic and wealth power cycle, and there's the international and wealth power cycle. Now, how did Ray Dalio find out about all of this? In 1971, he was 22 years old. On the 15th of August, 1971, President Nixon reneged on the fact of the promise that the US dollar was backed by gold. It was called the gold standard. And paper, you could swap your money, your US dollars, for gold. And because of that, the value of the US dollar plummeted. Now, that was a Sunday. He went in to the stock market the next morning because he was on the trading floor of Wall Street, and he expected the stock market to tank. But actually, it rose 4% in that one day. And what he realized, the more he researched, was that big economic and market moves happened in the last 100 years and in all major currencies when the currency devalued. He realized that there was a cause and effect relationship. And he ultimately put these down to his principles, which he's really made into algorithms. The way I understand them is that they are seen as patterns. I've spoken a lot about nature's laws, the law of gravity. If I drop this pen, it drops. There's cycles, known cycles of economics and politics. And so you've got patterns, nature's laws, cycles of economics, and cycles of politics, and they're all interacting. Now, the problem is that you'll miss the big picture patterns and cycles if you're caught up in the mini cycles. Now, if you've watched any of my webinars, I always say people get caught up in a crash, they get caught up in the coronavirus, and is it important or not? But they miss the big picture patterns and cycles. And this is really the outcome of all the studying that he's done. So let me go in and explain to you. So hopefully you've got an understanding now of how money, credit, and economics work. And if you haven't, and it was overwhelming, go and watch that video link that I've shared with you. It's 30 minutes, watch it 6 times, and you'll get an understanding. Danielle's saying, it doesn't feel good that I got it right. And someone else is saying, oh my God, Scott. Well, now you're starting to understand why last night, the more I understood this, the more I got concerned. But don't worry. If you stick with me, I've got good news for you. So let's look at the long-term debt cycle. It's generally 50 to 100 years. And in this cycle, interest rates are low and there's a lot of debt. Okay? Secondly, there's a widening of the wealth gap. And that's exactly the same pattern as to what happens in the 1930s. The haves get more and the have-nots have less. Thirdly, populism rises. You know, people become hard left or hard right. Same pattern as the 1930s. And one of the most important things in the long-term debt cycle is who is the reserve currency. Because if you are the country that owns the reserve currency, you have absolutely tremendous privilege. And to Daniel, what happened last night? Did Ray share something particularly that Scott is unpacking for us? No, Daniel, what happened over the last 48 hours is I immersed myself in a 48-hour study of everything that was Ray Dalio that I could find, past and present, and all his research and knowledge, and tried to synthesize it for this webinar. So that's the first cycle, the long-term debt cycle. The second is the domestic wealth and power cycle. So the problem with wealth values and political gaps is that they're at the biggest in our lifetime. People and the central banks are printing money and buying assets, which is called quantitative easing. Remember, that's monetary policy 2, which widens the wealth gap. And the buying of assets pushes up prices, which benefit the wealthy who hold more financial assets than the poor. And you can actually see that this is exactly what he wrote. I also wanted to point out in his research, and I love the graphs, that if you look at the US income shares and the US wealth shares, between the top 10%, which is green, and the bottom 90%, the wealth gap is worst in the 1930s and now, and equally is worst here in the 1930s and now, which is why there's so much outcry and unrest around the world. And then you've got the international wealth and power cycle. And this is where China is growing faster than the USA. The rise of China is competing in production, trade, technology, geopolitics, and world capital markets. And what I think is really important is that I'm going to go into this in a lot more detail. But what was so important is that if you look at the long-term debt cycle, the key thing here is who has the reserve currency and what is the fate of the US dollar. Because all reserve currencies in the past have ceased to be reserve currencies, often coming to a traumatic end for the countries that enjoyed the special privilege. So I also began to wonder, and when this is it's Ray Dalio, wonder whether, when, and why the dollar would decline against the world's leading reserve currency and how that would change the world as we know it. So what he did is he went out and he studied the Dutch guilder, so the Dutch, the British and the pound, America, and the Chinese, because his big belief is that history repeats itself and patterns repeat themselves, and you can learn a lot from history. He also studied Germany, France, Russia, Japan, China, and India. And what he realized was that empires last roughly 250 years. They are big economic, debt, and political cycles which run every 50 to 100 years, as we've discussed. And what he found was that China was dominant for centuries, consistently out-competing Europe in goods trade, though it entered a steep decline starting in the 1800s, and we're going to go into that in more detail. The Netherlands, a relatively small country, became the world's great empire in the 1600s, and primarily because of their shipbuilding abilities and the ability to do global trade. The UK followed a very similar path, peaking in the 1800s, and finally the US became the world's superpower of the last 150 years, though particularly during and after World War II, and now is in relative decline while China is catching up again. So let's understand this more, and I'm now going to go into more detail around the long-term debt cycle, because it's really important you understand this and why the reserve currency is so important. There's three ways to create wealth. The first is that you build it. The second is that you take it from others, like the British did in Africa. The third is that you find it in the ground, like they have done in the Middle East. And the fourth, well, it's not a way to create wealth, but the fourth most important thing is that the country that has enough wealth and power more than anyone else will get to determine the world order. And I hope that tonight, this is one of your key takeaways, that he or she who controls the world order is in a very, very strong place, and it's a huge privilege. And there's a lot of jostling to be that person. So let's look at build it. It comes down to human productivity is the most important force. The quality of people's education, inventiveness, the work ethic, the economic system to turn ideas into output. And there's actually 17 important forces which control all major movements of the debt cycle, the money and credit cycle, the wealth gap cycle, the geopolitical cycle. And when you look at it, what they did is they extrapolated the economies back to the 1500s. And you can see the big red line here is China, okay? And you can see what he was talking about the decline in the 1800s, and then the massive rise of China. You can see the orange is the Netherlands or Dutch, and the rise of them in the 1600s, and then their decline. Then you can see the United Kingdom, and the rise of the United Kingdom, and their dominance in the 1800s, and then their decline. And then you can see the rise of the United States, and then ultimately their decline. If you go back to 600, so literally another 1,000 years, you can see the dominance of China during this period. And then you can see the Mongol Empire, and ultimately you can see the Netherlands and Britain, and you can see China's rise again and America. Now, what's important is that the rise and decline of all major items, so whether it's education, trade, innovation and technology, output, competitive, financial center, military, you can see that they rise. They have a period of, and what does he call it now? They have an Asean Phase. They have a seeds of decline, which is when they're at their pinnacle, and then they're in a decline phase. And what's really interesting is that you've got forward-leading indicators, which are all of these things like education, trade, innovation and technology, output, competitiveness, financial center, and military. And then you've got lagging indicators, which are your reserve status. And so you can see that even though different countries have the rise and fall, it always follows the same patterns. And they tracked it and put them all together in terms of how it actually worked. So what was so interesting is that when they took the 17 items, and I'm going to talk about the Dutch just now, but the Dutch for 10 years had a decline where they lost their reserve currency. They had a war which they lost to Britain, and then they were invaded by France, and that was the end of the Dutch. The British was more gradual, and they had two major devaluations. But what was really important is that actually these 17 different items are what you should be tracking both for yourself, for your company, for your country, for your continent, and even for the planet. Because you want to be on the left-hand side rather than the right-hand side. And so if you go through this, just to start off with, does the world have good leadership capabilities at the moment? Yes or no? And you could rank it, 10 being left, 10 out of 10, 0 out of 10 being right. Education levels, character and determination, rule of law, corruption, resource allocation efficiency, openness to global thinking, productivity, output, growth, cost competitive, trade and capital flows, infrastructure and investment, indebtedness, military strength, the gaps in wealth, opportunity and values, internal conflict, social and political, geography, and acts of nature. Now, there's a thing here that he wrote about the Asean Phase. I'm going to read it to you. It's quite long, so bear with me. Around the upward trend of productivity gains that produce rising wealth and better living standards, there are cycles that produce prosperous periods of building in which the country is fundamentally strong because there are relatively low levels of indebtedness, relatively small wealth values and political gaps, people working effectively together to produce prosperity, good education and infrastructure, strong and capable leadership, and peaceful world order that is guided by one of the more dominant world powers. These are prosperous and enjoyable periods when they are taken to excess, which they always are, and the excess lead to the seeds of destruction, which is a depressing period of destruction and restructuring to which the country's fundamental weakness of high levels of indebtedness, large wealth, value, and political gaps, different factions of people unable to work well together, poor education and poor infrastructure, the struggle to maintain an overextended empire under the challenge of an emerging power rivals lead to a painful period of fighting, destruction, and then a restructuring that establishes a new world order, setting the stage for a new period of building. In this phase, which is ultimately the new phase, it's the transition phase. It takes 10 to 20 years between big economic and political cycles that occurred over many years, 50 to 100 years. These big cycles were comprised of swings between happy and prosperous periods in which wealth is pursued and created productively, and those with power work harmlessly to facilitate this, and miserable, depressing periods in which there are fights over wealth and power that disrupt harmony and productivity and sometimes lead to wars. So do you think that we're in a happy and prosperous period or a miserable, depressing period? Second rule is he who controls the gold, money, power, controls the rules. The transition is happening. So let's look at it quickly. When did America take over? As we've explained, the last period of destroying and restructuring happened between 1930 and 1945, which led to a new period of building and a new world order that began in 1945 with the global monetary system built in 1944 by Bretton Woods. And it was an American-dominated system where the United Nations was in New York, the World Bank and International Monetary Fund in Washington. The new American world order was a natural consequence of the US being the richest country. It had 80% of the world's gold stocks, and gold was then money. So this is, remember, 1945. The dominant economic power, it accounted for half of the world's production, and the strongest military. It had a monopoly on nuclear weapons and the strongest conventional forces. Okay, so what about the beginning of the end? When you look at the Dutch and how they lost it to the British, and then you look at the British and how they lost it to the US, there's literally 5 things that happen: debt restructuring and a debt crisis, internal revolution, peaceful or violent, that leads to large transfer of wealth from the haves to the have-nots. Think about the American election right now with Trump and Bernie Madoff. Not Bernie Madoff, Bernie Sanders. Who's the, I can't even remember who the combatant is. An external war, a big currency breakdown, and a new domestic, and sorry, Joe Biden, thank you. A new domestic and world order. And so, are we at the beginning of the end? It started in 1945, and it's been going for 75 years of prosperity. In 2008, the Fed pumped money, which created asset inflation. Remember, monetary policy 2. It's the same pattern as 1929 to 1932, when they had low interest rates and they were printing money. Interest rates are so low and there's so much debt that it's not stimulating the economy. And there's also huge pension and healthcare obligations. It's leading to the widening of the wealth gap, which is the same patterns as the 30s, and populism, which is the same patterns as the 30s. And this is the end of the long-term debt cycle where large debts and classic monetary policies don't work for the world's reserve currency, central banks. And so they now move, which is exactly where we are, to monetary policy 3, which is a coalition and coordination of fiscal policy and monetary policy in which central government does a lot of debt finance spending and central bank buys debt. And the only reason they do it is that they only use this when monetary policy 1 and monetary policy don't work, because it ultimately is the beginning of the end. And whether it's Donald Trump or Joe Biden, they are both committing over $10 trillion of further debt, which is all part of this monetary policy 3. Now, the reserve currency can generally take 2 to 4 big debt crises, banking crises and debt write-downs or devaluation of more than 30% before they are replaced. And what's interesting for me when I did my research is that the US denominated debt is 20 trillion. 50% of that, it's 50% higher than in 2008, and a bit less than 50% of this is short term. And so why are we moving into a new world order? When the crash happens, it generally takes 3 years. It's reversed through, and ultimately, so it's changed through a big restructuring of debt and money and the credit system and fiscal policies on taxation and spending. Changes in political power, a destruction periods, which are very scary. It's smart to believe and invest in humanity's inventiveness and adaptability. So this is the light at the end of the tunnel. You know, it's very important to believe in humanity's inventiveness and adaptability. It can lead to a depression, revolution, and war, and a change of the old system, which lasts 10 to 20 years. And that's why they often say you lose a decade or you lose a generation. And then you go back into the cycle of extended periods of peace and prosperity for another 40 to 80 years. And so let's look at the value of money. So we've looked at the reserve currency and why it's so important. Let's look at the value of money when it comes to the long-term money cycle. There's 6 stages. Firstly, it begins with no or low debt, which is known as hard money. So think of it like gold. It's an actual resource. It's like gold or silver. And you can't just swap it out or whatever. It's a physical, it gets mined out the ground. Then comes along claims on hard money, so aka notes or paper, because the problem is you and me can't walk around with gold bars in our pockets. So what we do is we have paper which says that I've got one, gold bar at the bank, and this piece of paper, says I own that piece of gold. Then comes along increasing debts, where the banks get clever and they realize, well, hang on, I've got a whole bunch of gold stored in my bank, in my vault, and I can lend out money, paper, against that gold. But what happens is there's often a run on the bank, and then comes a debt crisis, defaults, and devaluations. Step 4. Step 5 is when they move to fiat money. That's when they actually move away from hard money, and it literally becomes paper money backed by no intrinsic value. And then finally is when there's a flight back to hard money because no one trusts fiat money. So a good example of this that I've experienced is in Zimbabwe, where the Zim dollar literally went to nothing. And when I was back there 3 years ago, they tried to do bond notes, and no one was interested because it wasn't worth the paper it was printed on, and because it wasn't backed by anything. And so they went back to using tangible intrinsic assets, be it the US dollar, property, gold, pigs, goats, whatever. And so people need to decide what alternative store to hold wealth they will use. History teaches us they typically turn to gold, other currencies, and assets in other countries not having these problems, and stocks that retain their real value. By a store of wealth, I mean a vehicle for storing buying power between acquiring it and spending it. While people can store their wealth in assets that they expect will retain their value or appreciate, such as gold, gems, painting, real estate, stocks, and bonds, one of the most logical things to store it in has been money that one will use. So So people stored it in value, but remember, he said cash is trash. Let's look at why, printing and devaluing of money. So what's important is that now that we're moved from monetary policy 2 to monetary policy 3, they are actively printing and devaluing money. Sorry, that shouldn't say Monday, it should say money, as it's the easiest way out of the debt crisis. Remember, I showed you that, the inflationary way 4 days ago. You're seeing this happen now in response to the announcements of sending out large amounts of money and credit by central governments and central banks. All currencies have been devalued or died. So all currencies that have ever existed have been devalued or died. Of the roughly 750 currencies that have existed since 1700, only about 20% remain, and of those that remain, all have been devalued. So when you look at it again, the Dutch were the first to go, falling to the UK, and then the UK to the US. In these periods, there are large and growing debts that are monetized by the central bank printing money and the government buying debt. Remember, monetary policy 3. A weakening of the currency is a self-reinforcing run from the currency that can't be stopped because the fiscal and balance of payment deficits are too great for cutbacks to close. Very important to understand what's happening here. Once the downward spiral starts, there's no way to stop it. So central banks have typically continued to print money and buy debt directly or indirectly. And what they do in those countries is they outlaw the flow of money into inflation hedge assets and alternative currencies and alternative places. Someone just asked about cryptocurrencies. How many countries have they been banned in? It's a good example. Or even where you're not allowed to take money overseas, like there's exchange control, like in India, South Africa, or China. The US dollar accounts for 55% of the world's international transactions, savings, and borrowings. The Eurozone about 25%, the Japanese yen about 10%, and the Chinese renminbi about 2%. Most other currencies are not used internationally as mediums of exchange or stores of wealth, though they are used within countries. Those other currencies are the ones that even smart people in those countries, so people that live in South Africa with the Rand, or India or China, and virtually everyone outside those countries won't hold them as stores of wealth. People don't hold their money in the local currency. They want to hold it in first world currencies and ultimately the reserve currency. In contrast, the reserve currency I mentioned are the currencies that most people around the world would like to save, borrow, and transact, roughly in proportion to the percentages. Now, when you look at it and the changing value, what's interesting here is that he took it back to the 1600s, and he had the Dutch guilder, and then the British pound, and ultimately the US dollar. And he compared it to gold and the value of gold. And look at what happened here in terms of the value of gold and the depreciation that happened to the Dutch guilder, and then the depreciation that happened to the British pound, and then the depreciation that happened to the US dollar. Do you notice all the patterns are literally following each other? You can see here from the Dutch guilder what happened against gold and against the pound, and how it literally within 10 years lost its ascendancy from being the reserve currency to the British. And then when you look at the changing value of money and you look at the United Kingdom, look at how everything started to fall, including education and everything else. And their reserve status was the last thing to fall from the 1950s. So remember, it's always the lagging indicator. Now, when you look at the United States, look at the growth in the United States, okay, and things like education, and then look how it weaned off. Look at competitiveness, look at output, look at military, everything growing until the 1950s. And then this period of neutrality, and that's why the reserve status went up so strong. But remember, as they all start to fall, the reserve status is the next to follow. And so when you look at the rise and fall of the US dollar, this becomes really interesting. If you take $100 in 1913, today, $100 is worth $3.87. That's a decline of 97%. While the purchasing power of the dollar has gone up and down since 1913, it has never surpassed the purchasing power it had in 1913. The purchasing power of the US citizens has always topped the charts, but this could be changing in the future. Inflation impacts nearly all variables of macroeconomics, and many believe that the current US inflation levels are low. So in 1913, inflation levels are too low. In 1913, it costs $20.67 to buy an ounce of gold. Today, it costs $1,737 to buy the same ounce, which is a 99% devaluation. And so what's so interesting is that this all really started on the 5th of March, 1933, when Roosevelt put in place the monetary policy 3 with what they called helicopter money coming in. And you can see here, if I just show you a number of different graphs, if you look at the imports versus their exports, you can see that since the 1980s, America is a net importer, which means they need to borrow money from other people rather than being a productive net exporter. When you look at the amount of debt that they had, in 1945, they were lending to other people. So they were lending, they had a positive amount of money they were lending out. Now they're in a completely negative situation where the majority of the money is owned, the debt that they owe to other countries is owned by foreigners. And the only thing that's a saving grace for them is that they're the reserve currency. So if you look here, the amount of US debt held by foreigners, and look how it's grown even in the last 20 years. And what's really interesting is that when you look at Europe and look at the debt of Europe and look at the debt of Britain and you look at the debt of Japan, this is all what's happened since the coronavirus. So this has all happened. Literally, it started in the early 2000s. They went into monetary policy 2 in 2008 with the financial crisis. And now really with the coronavirus, they've gone into monetary policy 3, where debts are just spiraling out of control. And so what does it mean for the US during coronavirus? Well, look at what's happened in terms of unemployment. It has literally spiked. And that's just led to this huge growth of debt on the US dollar balance sheet. And so where to from here? Well, it's interesting because there's a gentleman called Stephen Roach that was the chairman of Morgan Stanley, came from Yale and actually was very big in Asia. And he believes that the US dollar is facing a collapse by the end of 2021 and over a 50% chance of a double dip recession. And what's quite interesting, if you go and look here at my notes, and I just want to go to the next page here, is that if you look at the big cycle, okay, so again, the New World Order. So again, remember America in the New World Order, 1945, then you got prosperity, then you start to get a debt bubble. Remember in 1971, they decoupled from gold, and so they started to get a debt bubble. Then the wealth gap became the worst it's ever been. In 2008, you had the debt bust, okay, and they started printing money and providing credit. And as Roger Hamilton said, now we've got revolutions and wars to look forward to. And then you've got a debt and political restructuring and ultimately a new world order. We're sitting right here at the moment in the big cycle. And the last part is that when you're in the big cycle, protecting one's wealth in times of war is difficult. Now remember, war doesn't necessarily mean guns and bullets and shooting each other. It can be trade wars, like what's happening with China and America right now. As normal economic activities are curtailed, traditional safe investments are not safe, capital mobility is limited, and high taxes are imposed when people and countries are fighting for their survival. During difficult times of conflict, protecting the wealth of those who have the wealth is not a priority relative to the redistributing of wealth to get it to where it's needed most. And so when you look at it, you can see the rise and fall of the Dutch, the rise and fall of the British, the rise and fall of America, and the rise of China. And this is where we sit at the moment. Since the early 1990s, there's been 3 economic cycles that have brought us to where we are now. One that peaked in the 2000 dot-com bubble that led to a recession that followed. One that peaked in the 2007 bubble that led to the 2008 global financial crisis. And one that peaked in 2019, just before 2020, Corona-triggered downturn. During the 1990 to 2000 period, we also saw the decline of the Soviet Union, the rise of China, globalization, and advances in technology that replaced people, which was good for corporate profits and widened the wealth and opportunity gaps. And when you look at it, and you look at the last 100 years, You can see back to 1930 when the cycle changed and how it's literally exactly the same. And then you had a new world order, and that's exactly what happened, a new world order. And you can see exactly what's happened here back in 2009 when the cycle changed and the expectant new world order. And so there's a great article which I've shared here about a gentleman that lived through Sri Lanka. And he explains how when you got a changing world order, you're dealing with chaos, you're dealing with Black Lives Matter, you're dealing with people burning things. It's not like there's a civil war. It's just a falling apart of society, as I've already explained to you from the 17 different constructs. And so when you look at it, the central bank's reserves, and ultimately if you come back to gold, who's got the money? And if you look at the US, the pound, and Russia, in terms of the amount of gold, China has far more money in gold stocks than anyone else by a long, 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 long way. And the only reason that America can even compete with China is because they've got the reserve currency at the moment. And so this article is fascinating about the new Silk Road and the Asian century on India, China, and the empire. Do you know that China is now the leader in tech and digital innovation? You know, China is one of the challenges they've got is digitization and decentralization. China's Belt and Road Initiative, the BRI, which is known as the New Silk Road, was announced by the China president in 2013. And since the 1800s, up to the 1800s, China and India had more than 50% of the world's GDP. In the 1940s, they had less than 10% of the world's GDP, and now they've got 26% of the world's GDP, of which 20% is China and 6% is India. In 2013, the purchasing parity, the PPP, purchase power parity, changed where China was now bigger than America. And by 2025 to 2030, China will be bigger in nominal terms than America. 6 of the top 10 economies are in Asia, 21 out of the 30 largest cities are in Asia, and 50% of the world's middle class are in Asia. And if there's a war, even a trade war, Asia will lose and America will win because the incumbent empire always wins. But they've got time on their side, and I'm going to show you something. But ultimately, the young want to prevent wars, and they want to focus on global responsibilities. And something that came out just this year, the Chinese president said at the United Nations that no country has the right to dominate global affairs, control the destiny of others, or keep advantages in development all to itself. Even less, he emphasized, should one be allowed to do whatever it likes and be the hegemon, bully, or boss of the world order. I think he was referring to Donald Trump. And so when you look at this, it's really quite interesting. Here's the PPP analysis that I just mentioned, and you can see how China has overtaken America. When you look at the innovation that's happening, and remember the changing world order, the graphs that I have shown you, look at how everything has been growing since the 1950s in China and massively in the last 30 years. And yet the reserve status, remember, is always a lagging indicator. When you look at these indicators in terms of China versus America on trade, output, innovation and tech, military, financial center, education, competitiveness, and reserve status, every single one of them, America is coming down and China's going up. And so that leads us to, you know, China actually launching its own digital currency, which they called the Digital Yuan, or the DCEP, which is the very first being launched by a central bank during COVID. They expect to bypass the banks. It'll be passed directly from one person to another, and it can be tracked all digitally. It's got zero transaction costs. It's faster than any of the traditional fiat systems, and there's no middlemen. And when you think about the explosion of the middle class in China, in India, in Southeast Asia, in Africa, you know, they desperately, you know, there's 900 million people in China just on WeChat. And, you know, 70% of the people in Africa have mobile phones now, and it'll be 100% in the next 3 to 5 years. And we take places like Africa, they've got high inflation, and the countries are really battling to get access to US dollar reserves. And that's why things like M-Pesa have grown. And that's how China is really starting to dominate. And one of the things that Ray Dalio talks about is that the way that the underdogs take over the incumbent is by working together. And so what's so interesting is where to from here. And he basically says that this is his study. It's very top down, big picture. He's got very low confidence on the outlook of the future. But please keep in mind that even with all this, I've been wrong many times that I can remember. And that is why I value diversification of all my bets above all else. Okay. For reasons explained in this book, I believe that we are now seeing an atypical big shift in relative wealth and power and the world order that will affect everyone in all countries in profound ways. So that's you and me, every single one of us. So how long will this take? According to both Ray Dalio and Stephen Roach, it's all going to happen in the next 2 to 5 years. So that's good news and that's bad news. You've got 2 to 5 years to prepare. Now, depending on how old you are, it's pretty much going to affect all of us. And so hopefully tonight is the start of a journey for you about the preparation. Now, the question is, with all the theory I've given you, what do you actually do? And so one's ability to anticipate and deal with the future depends on one's understanding of the cause-effect relationships that make things change. And hopefully I've shared with you a lot of those tonight, and I've given you all the resources if you want to go and study it, or you can watch this webinar again. One's ability to understand these cause-effect relationships comes from studying how they've played out in the past. That's why I've spent the last 48 hours really going deep into this, and I really believe that I've got it now. Whether I've been able to explain it effectively to you all or not, I'm not 100% sure, but I believe I understand it in my own head. And so I wanted to share with you this video, which is a brilliant video by Ray Dalio. It's at the TED Talk. There's a 50-minute version, but this is 3 minutes of what he says we should be doing during this current COVID crisis, crash, whatever you want to call it.
But that's very different from the passive investment market, which is such a huge part of it now. And that's where most people, the average person has their money. And I know that everything's changing day to day, but I also know that everyone's going to have this question on their mind. So I'm going to ask you, I'm not going to ask for specific investment advice, but everyone's thinking about their 401ks. Do you have any general thoughts about how people should approach this time period with that kind of money?
Yeah. First of all, an investor must understand that they probably will not be able to play the game well. They probably will not be able to decide how to move in and out of things. In order to be successful in the markets is more difficult than getting a gold medal in the Olympics. You wouldn't think about competing in the Olympics, but everybody thinks they can compete in the markets. But there's more money competing. It's like a zero-sum game, and there's more money doing it. And the worst thing you could do is think you can time all of these movements. I guarantee you the game's a tough game to time. We put hundreds of millions of dollars into the game every year, and it's tough. So what the individual investor needs to do is know how to diversify well. So the word that I would know how to diversify well and in a balanced way. The greatest mistake of all investors is to think that what has done well lately is a better investment rather than more expensive. And and what has done worse lately is the worst investment, get me out of it, rather than it's cheap. And unless you know how to deal with the differences of those, which most people don't, they're going to be in trouble. So understand that wealth, total amount of wealth in the world, essentially doesn't change very much, okay? And that one thing goes up, another thing goes down. And to know how to diversify it in asset classes, to diversify it in countries, to diversify it in currencies, to know how to diversify that well so that you have wealth diversification is important. Do not think that cash is a safe investment. Most people think, look, I just want safety. And those bonds aren't giving me an interest rate and so on. So where do I get safe? Cash is a seductive investment because it doesn't have as much volatility, but it taxes you in your buying power about 2% a year. And so, so cash is almost always the worst investment. So you have to think about that. You should think a little bit unconventionally. Do you have a little bit of gold? Do you have a little bit of asset in case this monetary system breaks down and money's redefined? Do you have a little bit of that? I can't get into all the different ways that one can diversify well. I try to convey those things in my books or on posts on LinkedIn particularly. But I would say diversify well, be humble, don't market time, and be conscious of the dangers of cash.
So there you have it. And I can see that a number of people are saying, thanks very much. And I'd highly recommend that you stay on because I've kept the best till last. So what's interesting, if you take and summarize what he said there, why is my slide not moving? It's around the 26th minute, and he said that people need to know how to diversify well and in a balanced way. You need to know how to diversify in assets, countries, and currencies. Knowing how to diversify your wealth is the most important thing. Do not think that cash is a safe investment. Cash is almost always the worst investment. Think a little bit unconventionally, diversify well, be humble, don't market time, and be conscious of the dangers of cash. So this is that book, Principles by Ray Dalio. So what does it mean to diversify across asset classes? Well, you've got to look at different asset classes. You've got financial assets, you've got real estate, you've got cryptocurrencies, you've got private equity, you've got convertible debts, etc. So you've got to diversify across asset classes. You've got to diversify within asset classes. So if you're in property and you own 10 houses, you're not diversified. If you own money in the stock market, in the London stock market, the New York Stock Exchange, and the Johannesburg Stock Exchange, the Shanghai Stock Exchange, you're not diversified because they all move in tandem. So you've got to diversify within asset classes. You've got to diversify across markets and currencies. All the commentary that I've read, if you're wanting to be a global citizen, you should have 50% of your assets in US dollars, 25% in euros. You've got yen, you've got pounds, based on the world numbers that I've given you already. Now I know when I understood this, and particularly with the devaluing of the US dollar, I realized I was pretty US dollar heavy, and I need to really get into euros and pounds more, and possibly even yen. And then you need to diversify across time. Some investments you want to get in with the next 3 to 6 months, and some you want to get in over the next 5 to 10 years. And so you've got to diversify across time. And what's really interesting is that he says you need 15 uncorrelated bets with an attractive array of assets that don't move in tandem. That'll reduce your risk by 80%, and your risk return ratio increases by a factor of 5. Now, whenever I give this webinar and this comment, everyone's eyes just shut. Like they literally go, I have no idea what you're talking about. And actually what I've realized is that there's two things that happen. Firstly, this is exactly what the financial industry wants you to do, which is think that you're stupid and you don't understand what's going on, and that you need to trust an advisor and pay them a whole bunch of fees. And secondly, that the concepts are actually generally a lot simpler than you think. And so what he's basically saying is, I don't like the word bets, but he's basically saying you need 15 investments that are not tied together. They need to be attractive assets and they don't move in tandem. That's all he's saying. So you need to find 15 assets that are attractive, that don't move in tandem. That's all he's saying. And if you can find 15 assets that are in attractive assets that don't move in tandem, you'll reduce your risk by 80%, and your risk return ratio will increase by a factor of 5, which is clearly a good thing. And so we basically created the wealth diversification marketplace back in April when Ray Dalio came out and was so strong in diversification. We've obviously got Wealth Migrate, which is the global real estate marketplace. And we thought, well, we need to be diversified. He said the most important thing to do now is to diversify across assets, countries, currencies, and across countries, currencies, and assets. And so if I go in to our platform, you can literally log in and you can get access to all our different properties and all the different types of investments. So you've got a American real estate deal, you've got a private equity deal, you've got a convertible debt deal, you've got a structured note deal, and there's multiple more different asset classes that are actually coming within. And the beauty is that you manage it all with your wallet. You've got everything in your wallet. And if I want to go in and literally invest in any one of these deals, I can literally go in. So let's just say I want to go to the convertible debt. I can literally go in. I can read all about it. I can read about the investment, the market summary, the investment summary. I'm not going to go into it tonight. You can read about all the information, the returns, and the risk ratings and everything else. And when I'm ready to invest, I can go invest in this deal. I can say, I want to invest $5,000. And you can see there that the deposit amount is $5,000, but you can see that the minimum on this one is $25,000. Okay, so I don't have $25,000 in my bank account. So now I go back to the marketplace and I say, right, I'm going to do a private equity investment. Okay, and I want to invest in this deal, and I put 10,000 in, and I go in, I literally confirm all the understandings and agreements. I download the documentation, I go agree, and ultimately it creates the document on my platform. And literally, I've got all the different banking details. So I can either do a pledge system or I can go in and use my wallet. And the nice thing with my wallet is that I can display it in all the different world currencies, and I can see what my value is. So the world has completely changed. And if people turn around to me nowadays and say, well, they don't have the ability to do 15 investments, my attitude to them is, you're lying to yourself. We've got a platform here. You can literally go in, you can look at the marketplace. It's a wealth diversification marketplace. All good quality assets are in here, be it real estate, be it private equity, be it convertible debts, and ultimately you get the ability to transact online safely and simply. Now, again, I'm not giving you financial advice. I'm just showing you how you can take advantage of what Ray Dalio is saying. And then my final question for you tonight is, do you want to be the fish? Okay, and what's interesting is that in the old way of doing business, everyone wanted to be the biggest fish. They want to try and so all diversification is not in USD. It's across multiple different countries and currencies. We've got pounds, we've got euros. So you've got all the different currencies, Heidi. But the question I've got for you is, do you want to be fish? And again, everyone's trying to be the biggest fish, or actually, do you want to be the whole ecosystem? It's a very, very different way of thinking about this. And so really, the world is changing. I got this just yesterday, that Crowdcube and Seedrs, that are two of the biggest equity crowdfunding platforms in Europe, are actually merging. So what tends to happen when markets consolidate is there's a time for mergers, strategic acquisitions, where it's no longer good enough to be the biggest fish. It's about being the ecosystem. And what does this actually mean? Well, as Ray Dalio says, to see the big picture, you can't focus on the details. Almost everything evolves on the uptrend which cycles around it. So remember that on all the webinars that we've done over the last couple of weeks, I've shown you all the massive trends, patterns that are taking place, and fundamentals. And really where this leaves us now is that we've gone from the hunting society, Society 1, to the agrarian society, Society 2, to the industrial society, Society 3, to the information society, Society 4, and now we're in Society 5.0. We are well and truly established. It's about digital transformation, it's about imagination and creativity, it's about problem solving, and it's about value creation. And ultimately, it's all about wealth 5.0. There's 5 major principles. It's about your impact and your purpose. How big an impact and purpose are you having in a positive way on this planet? What about creativity? How much value are you creating for others and for the world? That's part of your productivity. How much high touch? How much value are you adding to each individual that you connect with? How much tech are you using so that you can scale? And ultimately, from a digital perspective, how much future proofing are you doing? The world of an entrepreneur 5.0 has completely changed. It was all about building unicorns which were about monopoly and ultimately controlling everything. And it's now about zebras. It's about sustainability, community, quality, collaboration. It's about there's a profit and a purpose. And for investors, it's also changed. You know, Investor 4.0 was all about venture capital, whereas Investor 5.0 is all about venture growth, where the growth is determined by the investors. This is why you've been invited on this journey. And we've done webinars. There's scientific formulas that you can look at, which are exponential organizations, and Willem van der Post is one of the best in the world at this, where there's a formula to look for the ones that are going to be the most successful based on patterns and trends. And that's why we started out to say, you know, let's be the Amazon of global real estate. But as time went on and we looked at the Big Bang, which was the last greatest transfer of wealth, and ultimately what happened was that in 1965, the average share was, it took 6 years, it was held on the stock market. And then came along technology in the early 80s, and companies like E-Trade came along, and now they traded within 22 seconds. Companies like E-Trade democratized access to stock markets, both locally and internationally, and created a $14 billion company in the process. And when you look at real estate, and when I talk real estate, think all alternative investments, think convertible debt, think structured notes, think private equity, all the things that have only been available to the wealthiest people. Currently, they're all done off market. It's done by friends and family offices, and they're only for top-end investors. And generally a house is held for 8.7 years. How long do you think it's going to take until platforms change? So do you want to be the fish and focus on investing in a fish, or do you want to own the ecosystem? And so that's why we built the Global Wealth Group and the Meta Marketplace and the overall ecosystem. We've got real estate, we've got diversification, we've got genres, and we've got community. We've got global marketplaces, we've got local marketplaces, and we've got the platform sitting at the central. And that's why we call it the Amazon of personal wealth. It's powered by our platform Wealth, which is at the center. And whether it's a big institution like Investec that could be powered by Wealth, really where the world is going is all about personalization and digitization. And it's about this digital consumer and having hyper focus. And so why this is important is that, you know, one of the first real estate marketplaces we launched was Wealth Migrate. We launched the Wealth University and the Wealth Movement as part of community. We did Genius U, which is Roger Hamilton, Cashbox, Zuza, the Enterprise Development Property Fund, and now we've launched the Wealth Diversification marketplace. They're all live. We're about to launch Private Wealth, which is our ultra high net worth and high net worth brand. And we've got the Sapin launch. We're looking at Investec, Dalio, launching a South African platform, and with time, local platforms in all the different jurisdictions. Then we've got the focus with millennials and wealth, women and wealth, and even Sharia compliant. And so you can see that as time changes, we'll finally get it down to Wealth Create, where we will allow everybody to be able to invest from $1. And that's why we call it the Amazon of personal wealth. And the question is, can you afford not to be part of it? We've got a board and a team of advisors globally which specialize in all these different areas. And we really, really are privileged with the people who are prepared to be part of this team. We've got an astounding track record, members in 152 countries. We've done over $600 million in deals. We've paid out millions and millions of dollars in dividends, and we've got a higher than 70% reinvestment rate. And if you want to go and read about all the financials and the businesses, you know, please ask so that you can get access to the documentation so that you can understand it better. But in simple terms, there's three key metrics to the Global Wealth Group. It comes down to the number of transactions. It's literally like the world economy. It comes down to the average fees we earn per transaction and the average transaction size. We basically want to earn a plus more than 100 million in revenue, which will lead to a $1 billion valuation. To do that, we've got to increase the transactions. We've got to decrease the transaction size. We're looking to do 1 million transactions in a calendar year at an average fee of 5% with an average transaction size of $2,000, which is revenue of 100 million. And what are our exit strategies? Well, ultimately, we build in liquidity events for the current shareholders. We're looking at, one of the ways is a strategic sale, be it to a social media platform, or bank or investment firm, or a REIT or real estate company. And then probably the one that we're focusing on the most is a dual listing between the London Stock Exchange and the Hong Kong Stock Exchange, and maybe even a tokenization. So, in conclusion, where did this all come from? We learned a lot from Salesforce, which is a company started back in 1999. And they went out, and rather than getting money from venture capitalists, they got money from their community. And that gave us a wonderful idea, because they built a $50 billion company. And so we created the Wealth Collaborative Honey ecosystem. And it's empowered people co-creating a better world together. There's 6 different areas where people come together. And in simple terms, most people only get to invest in companies once they are IPO'd, be it Facebook or Amazon. Many people wish that they'd invested in Uber or Airbnb when it was private equity. But what we've allowed people to do is literally invest in high growth companies, which are well beyond the startup. And if you want to go and look at it, we did one with Cedars about 18 months ago, which was all, it's like doing a mini IPO. It's all regulated by the UK authorities. And you can go read about it at cedars.com/wealth migrate. We had 863 investors from 43 different countries. And what's really interesting to me is that when you look at, I did a webinar on this about a month ago, on the lessons we learned from the year 2000, and specifically from Amazon. And while all of Amazon's competitors were going bankrupt in these trialing times, like the dot-com boom bust of 2000, they did a convertible debt instrument, and that allowed them to innovate and ultimately to grow market share. And so we're doing exactly the same thing. We've got a $5 million raise, of which $2 million is debt and $3 million is equity. It's an opportunity for people to invest in the group via a convertible loan, offering investors a 7 to 10% per annum for 5 years, and then an automatic transfer into shares. Why are we doing it? Well, it's for strategic acquisitions and commercial acceleration of our business within an ecosystem model. We're targeting 10x in metrics and increasing our valuation dramatically on route to 100 million IPO. The returns are based on the size of the investment. Interest is paid quarterly, and it's secured against our real estate assets. So in times of turmoil, people want to protect their capital, and so it's protected against our real estate assets, and it's got more than 200% cover. We're doing it because with COVID and the whole evolution of Society 5.0 and Wealth 5.0, we've got the infrastructure both for local and global entrepreneurs and institutions who want to target specific client bases. And in doing so, we exponentially grow the meta marketplace. We are our own venture building on building fintech entrepreneurs and expanding the business within an ecosystem model, basically becoming an incubation hub. And this is all in line with our valuations and what we're wanting to do with our dual listing, and ultimately with where we want to go in terms of growing the company to $1 billion valuation over the next 5 to 7 years. Each acquisition target grows the value by leveraging within the whole global ecosystem and the worldwide wealth community and the digital technology to significantly increase their revenue and profitability, and vice versa. And so it's really the convertible debt opportunity is up to 2 million. We've got a silver level, which is a $25,000 investment. It's a 7% interest and a 3% discount on the current share price. So imagine being able to secure your share price now in Amazon, but only pay for it in 5 years. We've got a gold level, which is 100,000 at an 8% interest and a 7% discount. And we've got a platinum level, which is a 250,000. It's a 10% interest, Class A shares, which are preference shares, and a 12% discount. And then finally, under the notes, it converts in 5 years. There's a minimum of 24 months of interest, which is kept. The capital is protected against the real estate assets. We've already got 800,000 in the bank. We've got another 400,000 in contracts, and we've got warm commitments of over $1 million. And so, where's this investment going to be invested? Ultimately in the CapEx, continuing to grow the marketplace. In the digital products, the branding and the marketing, in the meta marketplace, the human capacity and the OpEx, and the compliance and the corporate governance. And finally, in terms of the next steps, you can actually go to the landing page, online.wealthmigrate.com/GWG. You can speak to a wealth consultant, and I'd highly recommend talking to one of our team and understanding if you've got any questions or challenges. And or you can go directly to the platform, Wealth Diversification Marketplace, and I'll put all the links up for you so that you can go and get access to them. And so I just want to see if there's any questions, and I want to run a quick poll. I've got 6 things that I promised that I would share with you on how you can not only protect yourself, but how you can be profitable during these times. And once the poll is finished, I will then give you those 6 things. Will the recording be made available via email to participants? Yes, Andile. We will make it available to people that signed up, as well as people that are part of our inner circle and on social media. Heidi said all our diversification in USD. I think I answered that. No, it's in the different currencies and countries. Is this a different place? So yes, Danielle, we've got Wealth Migrate, which is the global real estate marketplace, and we've got the Wealth Diversification marketplace, which is for all other assets. And Artem, we definitely need to talk, because countries like Russia, South Africa, India, China, and many other emerging economies are very, very interested at the moment in terms of wanting to get into first world assets to protect their wealth. And so please give me a favor and fill in the poll. I'm going to take a quick slug of water. If anyone's got any questions, fire them through. And remember to stay online so that I can share with you the 6 things that you can not only use to protect yourself, but also profit, which I picked up from all the research I did with Ray Dalio. Parisha, if you're asking the question, how can we apply to Cedars deals? We do have a private equity component and a convertible debt component. So you can buy shares directly, just like we did at the Cedars level. Again, I would suggest talking to a wealth consultant. I will put the link in here quickly to both those different links that I put through. So you can see them here. So I've put them in the chat box for everybody. You can see this page. It's got the useful resources. You can download the page. You can join the investor groups. You can read all about it. And most importantly, you can talk to one of our wealth consultants. You can also watch a video of what all our other wealth partners have had to say from the experience. And then if you want to go to the Wealth Diversification Marketplace, I've put the link in there. Some of you might just want to go online directly and actually invest directly. So I can see that 34% of you have invested. Sorry, not invested, have answered the poll. I'm going to just leave it open for another 10 seconds. And I want to move you can see Lee's details there as well. If you want to reach out to Lee directly, she's head of community and will be able to help you. The other thing is that we've got some webinars coming up. You might or might not have noticed the whole trend here and how we've evolved. We're now moving into technology and how it's changing property. We've got Prof. Veruli, that's one of the most respected authorities in the space in how technology is changing property and is a property economist. So that's on the 20th of October. We'll then be talking about Society 5.0, Entrepreneur 5.0, Investor 5.0, and Wealth 5.0, and what we really need to focus on in the next decade in terms of what's happening. And then finally, we've got a panel bringing it all together where the future is coming faster than you think. And we've got Willem van der Post and David Orban. Probably neither of them need any introductions. And so I'm going to end the poll. If you do want to click on it, let me know if there's anything that we can help with. We would love to be able to assist you. So let me end the poll. Otherwise, just ask me any questions. And let me move to the conclusion. And so, in conclusion, what's interesting with the 6 lessons? The first is you need to diversify. You need to diversify your cash itself. If you've got all your money in rands, you're crazy, or in RMB, or in US dollars, you're crazy. You need to diversify. You need to be in dollars, you need to be in pounds, you need to be in in Japanese yen, Australian dollars, Singapore dollars, etc. You've got to diversify the cash itself. And the beauty with our digital wallets is that you now get access to be able to do that safely and simply. You need to diversify across partners, regions, and even take into account trends. So, what's happening in the world is that the emerging economies and technologies, emerging technologies are, I did a webinar 2 weeks ago on the 8 major technology trends and the 8 societal trends that are intersecting in this next decade. Now, if you overlay these trends along with the patterns and that we've just explained tonight, you can see the power of what is happening in the next 5 to 10 years. And you can either see it as a very, very scary time, which it's going to be for the unprepared, or you can see it as a huge paradigm shift, a changing world order where there's tremendous opportunity and you can get to participate and to take advantage. Remember that good entrepreneurs and investors, chaos equals opportunity if you're prepared. You need to hedge against the dollar. You need to look at gold, silver, and Bitcoin. You need to look at property and other financial assets. A lot of our very wealthy people are investing in structured notes, up to 25% of their entire portfolio. They're investing in private equity. They're investing in convertible debts and debt instruments. You need to be looking at hedges against the dollar. And one thing I learned in Zimbabwe was, Zimbabwe had this terrible hyperinflation, and yet intrinsic assets, things like property, actually retain value in whatever currency became the de facto currency. They also are inflationary, so they protect against inflation. You need to look at cash generating assets. Whatever your acquisition strategy is, you need to buy assets that are going to make you money. Whether that is, and when I say make you money, it's make you income. Whether that's businesses that are income generating, whether that's properties that are income generating, whether that's debt instruments that pay you income. The most important thing is income and cash flow driven businesses and assets. And then, finally, you need to invest like the top 1% and like hedge funds. They invest, and I explained to you right up front how hedge funds do it. And you need to copy them. If you want to be successful, copy successful people. You need to look at your debts. It's interesting, if governments around the world are looking to decrease their own debts, they're devaluing the value of money, which ultimately halves the value of your debt. And so you need to try and borrow as much as you can and buy financial assets, just like the government is doing. And then finally, the one thing that Willem van der Post spoke about is that you need to focus on purpose-driven businesses, purpose-driven assets and investments. Ray Dalio went on to say that, a lot of this negativity that he's talking about can be changed if people are willing to change. I think the most important question is how we adapt and change by asking ourselves and honestly answering some difficult questions. We need to look at whether the policies are not just optimizing these efficiencies, but if these benefits are being spread broad-based. Increases in the size of the pie by increasing productivity and dividing it well. Imagine if you had a goal like to solve the wealth gap or empower the 99% to be able to invest like the top 1%. These are purposes that people buy into that are meaningful and important to them, and they can not only be profitable in their life, but they can be purposeful at the same time. And so why people partner with us? Well, they want to make a profit. Our target is to 10x your investment in the next 5 to 7 years. And really now with where the world is going, I'm certainly disappointed by, the way things have transpired over the last 5 years. It's taken longer than I would have liked, but now the world is accelerating and you're starting to see accelerating returns. We've got a global community that learns, grows, and invests together with like-minded people. There's nothing more powerful than global citizens working together to create the life that they want, to learn, grow, and invest together. It's the greatest privilege that I have to be part of this global community of investors from 42 countries. And then finally, be part of a massive purpose. Solve the biggest challenges on the planet and allow the 99% to invest like the top 1% using technology and smart investing. And in conclusion, I got this from Roger Hamilton. He said, it's more important. Ray Dalio said, it's more important to do the big things well than the small things perfectly. And so tonight, hopefully, we've shared with you, and sorry, whatever time zone or time you're watching this, because we've got people everywhere from America right through to way in the East. It's important to do the big things rather than the small things. Tonight, I've tried to focus on the big frameworks. I've tried to show you all the different major things that are intersecting and why the world is in such a precarious position, why we are going to have a changing world order. And also, I've given you solutions of how you can invest so that you can diversify and copy what Ray Dalio is recommending, and that's being the fish. And I've shared with you the way that you can actually invest and own the entire ecosystem, which is, on the cusp of riding this massive wave of structural change within the world order. And so, in conclusion, this is a picture of my son when he was 5, investing in things like property and owning red houses and green hotels and earning a passive income is what we call smart investing. His team with an incredible group has taken that reality, and you can now own a globally diversified portfolio across countries, assets, and currencies. It's what we call smart investing. The wealthiest people in the world, they are investing in a particular way, and it's all about generational wealth. It's what we call smart investing. And we aim to put smart investing in every single person's pocket. That's all from me tonight. I want to see if there's any questions here. I'll go back to that page, which has the call to actions. If you're interested, let me see. There's a couple of things that are coming through here. Thanks for all the positive comments. I really appreciate it. A hell of a lot of work went into this, and so I hope that it's added value to you. Oh, sorry. I see you said that Russia is going to be creating the digital ruble. There were another couple of slides that I wanted to share with you, which I didn't. Couple of things. Lemonway, which is our digital wallet provider, has now leveraged RippleNet to unlock faster euro payments. They've also looking at tokenization for digital securities. So it's awesome to be partnering with one of the best in the world. This was the update of the merger. These are all the different webinars that you'll get after this link. And then Dalio says time is on China's side in the power struggle with the US. So again, with these changing world orders, China is like a sleeping giant. And as I've shown you tonight, all of the indicators are going in the right direction for China, and all of the indicators are going in the wrong direction for America. And so that's just some stuff that I wanted to share with you. All those links are in the thing. Any plans for investment in China in the immediate future? Kevin, we are talking with our team. We've got a team in China, Wealth Migrate China. We are talking to them about doing local investments. Scott and Lee, thanks for the support. That's very much appreciated. I'm learning a lot through these webinar programs each and every time. Peter, so thanks very much, Peter. Daniel, amazing webinar. Thanks for this. Might be able to have a call, but current PE is just about investable cash we have. Great webinar, good summary of Ray's work. Loved it. Enjoying your journey and would like to be more part of it. Perfect, Daniel. We're always looking for people to be more part. Thanks for your time, explanation. Most useful, Mike. Thanks, Scott and Lee. So Lee's actually on leave tonight. She's got a week's leave. She's with her husband in the Saudi Arabian desert after 7 months of being locked down in lockdown and being away from her family, her husband and her family for 7 months. Basil and said, Scott and Lee, thanks for your sound research time and efforts. Lana said, thank you so much for the incredible knowledge and advice. My concern is that this is all that is exciting until the IP grid goes down, which I think is highly possible because it's under the control of governments. Then we'll be totally paralyzed. Then a few dollars under the mattress is important, and veggies in your back garden. Yeah, maybe. Again, in Zimbabwe, we can see how that works. Karen said, thank you. Jacqueline said, thank you. I love being part of this. Bit old to be starting and not rich yet, but learning how to get there. So I completely agree with you. Barry said, Carpe Diem. Ingrid, thank you. Thank you. Jing, thanks. Thanks. Lots of enlightening information. So if you did enjoy these, please share it with your friends. Huge amount of work goes into them. We are looking to add as much value as possible. And Artin says Russia is helping China with oil and gas. Contact Asaya, the China-Africa series. I'll send the link. Thanks, Scott. Thanks very much. Thanks. I'm just sorry, seeing if there are any questions. Thanks for all the kind messages. We need to talk, so Artin will talk. Well done. So let me I'll write down your number there, Artem, just so I've got it. If you're on WhatsApp, I'll send you a quick WhatsApp, 790232532216. You can watch all the recordings as well. And we've got 3 more webinars to go. So please make sure that you share it with others. Can we download the slides? Yes, Sydney, I'll put them up on SlideShare. Artem's saying he doesn't have WhatsApp. Okay, not sure how to contact you, Artem, but anyway, we'll make a plan. Need a replay as was interrupted. So really in simple terms, just want to say thank you to everyone. These are all the links that you'll be getting at the end of the PowerPoint. So you can go and click on all the different links and just a disclaimer at the end. So that's all from me. I hope we added a lot of value to you. To remind you, if you want to be successful in life, patterns, trends, and fundamentals are critically important. It's one of the reasons why I love Ray Dalio so much and I respect him so much, is that he's prepared to put in the research. And I really want to thank all of you because, tonight forced me to go and do all that research. And I've got a far better understanding of where the world is. As I said to you, I'm really concerned about the big macroeconomic changes, which are going to change over the next 2 to 5 years. But I'm equally excited for where we are placed as a business and as an investment community. I do want to just see here if I've got any more other notes that I had, because I wrote down a huge amount of notes here. And I think I've been through them all, but I just want to make sure there weren't any other pearls of wisdom that I've left out for you. So one thing he did say, Ray Dalio, is, let me just go back to this page here. He did say that the risk premiums, when currently close to zero when borrowing, thus PE ratios are not a way of investing at the moment. So looking at the old fundamentals don't work. The risk premium is driven by the amount of liquidity, and ultimately it gets driven down. You don't want cash and bonds. You get no interest, and he did mention that. You get a negative real rate, and central banks are going to print more. There's a lot of uncertainty about the election, so this was just news that I looked at this afternoon. And who's going to win the elections in America? And the worst case scenario is that there's not an outright winner. Capital markets are controlled by central banks who determine who gets the money. So remember, that's monetary policy 3. Central banks' balance sheets are exploding and valuations don't reflect fundamentals. And then what's a good store of wealth? Something that's the reciprocal value of money. So it holds reflation assets, so it grows with the inflation and gets returns. So cash returns that we spoke about. Equities, you need to be careful because they're not economically susceptible. Gold, property, and you need to learn the lessons of what happened in 1931, 1971, and 2008. And then finally, the limit is that when there's no demand for the debt. So America's been able to print all this debt because there's been so much demand for US dollars and American debt. And when there's an example of a war, as I said to you, it's a very difficult time. And what's interesting is that America's been in existence for 242 years, and only 16 years of those 242 years have they actually been in peace. So they've got military bases in 70 different countries. So ultimately, America is pushing the limits in terms of what is happening. And then lastly, in past times in history, there's been 16 challenges to world power, of which 12 of them have ended in war. And then ultimately people move on to thriving. And there's different trade wars going on. There's cycles. There's a technology war going on between China and America. And there's even geopolitical tension over Taiwan. And I think, ladies and gentlemen, you know, he said here in the diversification, you need to look at gold and inflation-backed financial assets, and you need more global holdings rather than America. So it's so interesting. Everyone from around the world is trying to get into America, and the most respected authority in America is telling Americans to get out of America. And then finally, he said, be careful of your dangerous bias. Your past representation is not your future representation. And so hopefully that's all from me. I think that we have covered quite a lot tonight and hopefully added lots of different value. Are there any ideas that you have if the internet is disrupted? Yeah, so, I mean, as an example, our platform has multiple servers on multiple different continents. And so it's very difficult for it to be disrupted by any one country. Remember that the internet is bigger than one country or government. And so because the servers are in the sky and on multiple continents, it's very difficult for it to be switched off, and even more difficult with mobile phones. And so I don't think governments will switch it off. I think it's more that they'll embrace them with digitization, like the digital yuan, because it's far more digitally trackable. The question is not whether they'll switch the internet off, it's whether you'll lose your privacy, because that's happening. Cool, and thanks for all the very kind words. Really, really appreciate it. So I'm going to go back to the thank you page. I'm going to stop sharing, and I think that's enough for tonight. I've been up since 2 a.m. last night, up at 8 a.m. for all the preparation, and so I think that now my eyes and my body need to rest. Look forward to seeing you on the next webinar with Prof. Aruli. Have a lovely evening. Make sure you speak to one of our wealth consultants. I believe that we've got a very exciting 5 to 10 years ahead of us, and we want to build a phenomenal global community that is not only profitable, but also purposeful. It's not for everybody, but for the right people, we want to invite you on that journey. Cheers.